If you are new to superannuation or want to know how superannuation investments work, then we will explain everything in this video about your investment options within superannuation. We will explain the choices you have and what you should be investing in within your superannuation fund to maximize your retirement savings for the day when you will be using these funds to live on after retiring. Hi, and welcome to the Retire Well project. As a retired financial advisor, my aim is to make sure people understand superannuation and use it wisely to maximize their retirement benefits. I have seen countless young people and older people making crucial mistakes about their investment options within superannuation that can make a huge difference to the long-term performance of your superannuation returns. Let's start with the basics. Superannuation, or super, is essentially a long-term savings account that's designed to give you an income when you retire. It was introduced in 1992 because the majority of people who retired prior to that date had little or no savings and were totally dependent on the government age pension. The government requires your employer to put a percentage of your salary, currently 11.5%, into your super fund. That's called the superannuation guarantee. Think of it as money you're earning today that's locked away for the future. From the 1st of July 2025, this increases to 12% of your income. Now, here's the exciting part. That money doesn't just sit there. It's invested by your super fund in things like shares, property and bonds, with the goal of growing your balance over time. The earlier you start paying attention to your super, the more time it has to grow, thanks to the magic of compound interest. That's when your money earns returns, and then those returns earn returns, and so on. Over time, it can snowball into a significant amount. I've seen young people ignore their super for years, thinking it's something they'll deal with later. Don't make that mistake. The earlier you start, the better off you'll be. Even small changes now can make a huge difference down the track. Now, let's talk about where your super goes. When your employer makes contributions, the money goes into a super fund. But not all super funds are created equal. There are two main types: industry funds and retail funds, which we will discuss in this video. There are also corporate super funds that cater for people mainly in government roles like the public service and military. Plus, there are self-managed super funds, which are designed for people with larger sums of superannuation money. Industry funds are often linked to specific industries like healthcare or construction, but most of them are open to everyone these days. They're run to benefit their members. They don't have shareholders to pay, so any profits they make go back into the fund to benefit members. That usually means lower fees and, in many cases, better returns. Retail funds, on the other hand, are run by big financial companies like banks and insurance firms. They're designed to make a profit for their shareholders, which often means higher fees. While retail funds might cost more, they normally offer a greater choice of investment options, which can be beneficial if you have a larger superannuation balance and want to diversify. If you are just starting out in your career and know little about superannuation funds, it is likely you have accepted the default superannuation fund nominated by your employer. All employers are required to provide a default fund known as a MySuper product, which is a simple, low-cost superannuation product designed to make super easier to manage for employees who don't actively choose a fund. You have the right to choose your own super fund, and employers must direct contributions to your chosen fund instead of the default fund. If you have an existing fund, your employer will pay into this fund unless you nominate another fund. The ATO website provides a useful tool to compare fees and investment returns for all MySuper funds. Comparing fees is as important as investment returns, as even a 1% difference in fees could make a huge difference in your returns over the long term. We have another video on fees in super funds, which you can check out in the description below. But for now, let's concentrate on investments in superannuation. When it comes to investing your super, time is your biggest advantage. The longer your money is invested, the more time it has to grow. And when you're young, you can afford to take on more risk because you've got decades ahead of you to ride out the ups and downs of the market. Let me explain. Super funds invest your money in a mix of assets. When it comes to choosing what groups of assets they invest in, there are three broad groups or asset classes they fall into. The first is what we call growth assets. These are typically investments into shares and property. They are classed as growth investments because they normally have two components which make them grow. The first is the increase in their share price, which we call capital growth, and the same for a property investment when it goes up in value. The second component is what we call income, and this is where the shares provide dividends to shareholders based on the profits they generate. If it's a property investment, then think of rental income these properties generate, which can be returned to shareholders. Superannuation investments control a large portion of the market. According to the Australian Bureau of Statistics, employers paid over $103 billion in wages in September 2024. If you were to estimate the superannuation contribution on this amount at 11.5%, you are looking at roughly $11.8 billion of new investment each month. As a result, superannuation funds invest millions at a time in a range of investments every month. They have investments in most major shopping complexes, office buildings, commercial property and infrastructure assets like airports, toll roads and utilities. The second asset class that superannuation funds also invest into is what we describe as alternative asset classes. This could include investments in commodities like gold, which is often used as a hedge against inflation. They can also invest into what are called hedge funds, which are actively managed funds that use various strategies to achieve positive returns regardless of market conditions. Think of a market or commodity that may be falling in value. A hedge fund, instead of buying, may take a sell position and hope to gain from a fall in the value of shares or investment they bought. Included in alternative asset classes is infrastructure debt, where superannuation funds make large loans to infrastructure projects, providing steady income with relatively low risk. Projects like Melbourne Airport, Stockyard Hill Wind Farm and WestConnex Toll Road in Sydney are examples of superannuation infrastructure debt. The last broad asset class we have is called defensive assets. This typically includes cash and fixed interest investments and takes the form of government and corporate bonds and other debt securities such as cash held in bank accounts and fixed interest investments where they may be invested for a fixed period of time over months or years. Most defensive assets typically only have one component, and that is income. They have no or little exposure to capital growth, either up or down, which is why they are referred to as defensive assets. Australian super funds invest mostly into growth and defensive asset classes. Many will have exposure to alternative asset classes, but this is normally a lot less than their exposure to growth and defensive assets. When you invest in growth assets like shares, you're essentially buying a small piece of a company. If that company does well, if it grows, makes profits, and increases in value, your shares go up in value too. Now, shares can be a bit of a roller coaster. Their value can go up and down depending on what's happening in the economy, in politics, and even in global events. But here's the thing. Over the long term, shares tend to outperform other types of investments. I've seen this play out over and over again during my career. The short-term volatility can be nerve-wracking, but if you stay invested, you're likely to come out ahead. The All Ordinaries Accumulation Index is a measure of the top 500 companies in Australia. Since 1900, the index has averaged a return of 13% per annum, including dividends. Over that time, there were 24 years where the index fell in value, and 100 years where it grew in value. There have been only 5 instances over 124 years where the index had negative returns over 2 consecutive years, and on each occasion, the following year provided a double-digit positive return. To put it into perspective on an individual share price, you can look at one such company inside the ASX All Ordinaries Index like Commonwealth Bank. It listed on the Australian Stock Exchange back in 1991 for a little over $5 per share, and at the time of writing is trading at $162 per share. In that time, the share price has fallen many times in market downturns, but each time recovered. It has also paid a dividend to shareholders every year since it listed. This is a good example of a growth share that provides both components of capital growth and income. You will find that the majority of super funds have exposure to this index or directly with the individual companies in the index, as they are considered to be the best companies in Australia that provide the opportunity for capital growth along with consistent dividends or the prospect of dividends. The best part about investing through your super is that the fund does all the heavy lifting for you. They diversify your investments, spreading your money across different companies, industries, and even countries. This reduces your risk and gives you exposure to a wide range of opportunities. So, if you're young and just starting out, don't shy away from growth. It's the best way to make the most of your super over the long term. Choosing the right investment option in superannuation. If you are using a default superannuation fund or investment option, then anywhere from 10% to 50% of your superannuation funds may be invested in defensive assets like cash. Unless you are retiring in the next 3 to 5 years, you will not need cash in your super fund except to cover any fees and insurance premiums you may have. If you are under 50, you still have at least 10 years or longer to access your super, so having more than 10% of your super fund invested in cash means you will likely have a smaller superannuation balance when you get to retirement. Look for an investment option within your super fund that gives you more exposure to growth assets with a minimal amount exposed to cash. This will give you the best option to grow your super over the long term. When you get to within 3 to 5 years of retirement, then you need to consider having more exposure to defensive assets depending on what your income needs may be at that time. The other mistake many people make is to change their investment option to a more defensive option like cash when there is a market fall. Doing this crystallizes any losses your investments have incurred at that point in time. As history has shown, market downturns will always recover. So avoid the temptation to move your investments during market volatility and keep your focus on the time frame you have for investing. Here's a quick tip. Watch out for fees. Even a small difference in fees can add up to tens of thousands of dollars over your working life. Compare funds and choose one with low fees and good performance. It's a simple step that can make a huge difference. All right, let's wrap this up with a few quick tips. Choose a growth-focused investment option while you're young. Compare fees and pick a fund that offers good value. Consider making extra contributions. Even a little bit can go a long way. Consolidate your super accounts if you have more than one. And most importantly, start paying attention to your super now. The earlier you start, the better off you'll be. Superannuation might not seem exciting now, but trust me, it's one of the most important things you can focus on when you're young. Thanks for watching, and if you found this helpful, don't forget to like and subscribe for more tips.